Hello and welcome dear students. So now we are left with the last part of your amendment lecture for previous year 1920, assessment year 2021, applicable for May 20 and November 20 exams in the order of the textbook, my textbook. Next chapter that we have is your chapter called transfer pricing. Out of the two amendments that have taken place in transfer pricing, first amendment I already taught you even while doing our chapter MAT, that is minimum alternate tax, in respect of newly incorporated manufacturing companies. Under the new section 115 BAB, a concessional rate of 15% plus 10% surcharge plus 4% HEC. Your surcharge is going to be compulsory, irrespective of your income, compulsory, and with which the effective tax rate came to 17.16%, and plus MAT is also not applicable. Company incorporated on or after 1st October 2019 and starts manufacturing before 31st March 2023 will be getting this facility, plus the second benefit is that MAT will also not be applicable, which is why it is possible that any assessee having two organizations, one which qualifies under 115 BAB, and the other which is not qualified for 115 BAB concessional tax rate, their inter-business transfer can take place at a price other than market value, and therefore we are making this clarification that this will also be covered in the definition of specified domestic transaction. So existing definition of specified, and by the way this came through the ordinance because 115 BAB only came in the ordinance, so this amendment came in the ordinance. The existing definition of domestic transfer pricing, specified domestic transaction, covered 40A subsection 2, which was deleted some years ago. Now it covers only your 10AA SEZ and income related chapter 6A deduction. But now any company taking the concessional tax rate in 115 BAB, if it is having any transaction with associated enterprise, then it is likely that the company will shift its profit to this company because of the beneficial concessional tax rate. It is likely that you will book your profits. It is likely that you will book your profits in this company because of concessional tax rate. So that inter-business transfer has to take place at fair market value, and that is, it is going to be covered in domestic transfer pricing. Next change has taken place from 1st September. So first of all, you have to be aware that it is an amendment in the middle of the year. We are talking about section 92 CE. Since the time section 92 CE has been enacted, that is last 2 years, from AY 18-19, from May 18 attempt onwards, every batch after batch, attempt after attempt, I have been telling students that section 92 CE is a disastrous section under income tax. Horrible section 92 CE, as per which whatever is your transfer pricing adjustment, we will call it the primary adjustment, you have to show that in your books of accounts by making secondary adjustment. Section 92 CE is talking about secondary adjustment. That means whatever is your transfer pricing addition in your computation, you have to also show that income in your books of accounts. So your books and your tax profit should be same. There should not be any difference because of transfer pricing. But this you will have to change in the books of your associated enterprise also. Not just that, you will have to receive that money from the associated enterprise within the prescribed time limit, and if you don't receive that money from your associated enterprise within the prescribed time limit, then it is going to be considered as a loan given to associated enterprise and we have to pay tax on notional interest. First of all, our associated enterprise will not modify books of accounts. Secondly, there is no question of repatriation of money. Thirdly, if you add interest, again it will get added to the amount and that money is never going to come back. That means one thing is for sure, the amount of secondary adjustment which we are crediting the income and debiting the account of the associated enterprise, that amount we are never going to receive from the associated enterprise. So will the interest be continuously calculated lifetime, the notional interest? No. Now they are giving you an option. If the excess money has not been repatriated within the time, assessee will have an option. By the way, they have fooled us. Every assessee will have to exercise this option only because they are never going to get the money from the associated enterprise. You have the option that on that amount of secondary adjustment, pay tax at 18%, plus compulsory 12% surcharge plus compulsory 4% cess. 18% plus 12% plus 4%, and if you pay this one time tax, then you are not required to make any secondary adjustment or compute any notional interest. But this will happen from the date of payment of this 18%. So if you do not repatriate the money within the prescribed time limit, then from that date till actual payment of this 18% tax, the notional interest will be added in your income. But once you pay this 18%, and you have got no choice, because you are never going to get this money from your associated enterprise over and above your normal income tax. Can I say transfer pricing addition is an addition in your net taxable total income? We have added that amount in NTTI, that was called primary adjustment, and now we want to reflect that amount in our books of accounts. That is going to become secondary adjustment. We will have to receive that money, but right from the time this section got enacted right from the time this section got enacted, we have been saying that it is impossible to repatriate that money. It is not going to happen. So now very smartly they say, okay, it is not going to happen, no problem. You are already paying normal tax because this amount has become primary adjustment in your computation of total income, that is NTTI. In that it is added in the form of primary adjustment. That means already you are paying normal tax plus pay an extra one-time tax at 18%, 12% surcharge, 4% HEC. Pay this extra amount as a one-time tax. Pay this extra amount as a one-time tax, and you don't need to do the secondary adjustment or repatriate the money. Basically, they wanted 18% extra, but they did not bring the amendment at one go. First they said make secondary adjustment, and after 2 years they are saying if you cannot make secondary adjustment, then pay this tax. In effect, they are going to take tax, extra tax on that amount of transfer pricing adjustment, on that amount of transfer pricing adjustment in the form of 18%. They are just taking extra tax. Have we understood? All of us following what is happening? Fantastic. Let's go ahead. Now we enter topics in our IPCC textbook. IPCC chapters are not taught by most faculties in CA final, and you have chosen a rare professor who teaches IPCC topics also in CA final. So we will go ahead of income wise. First head of income, income from salary. This came in the interim budget. It was like a gift just before elections. The standard deduction, which was introduced last year only at 40,000, we are increasing the standard deduction from salary from 40,000 rupees to 50,000 rupees. So till AY 18-19 there was no standard deduction. In AY 19-20 they introduced standard deduction of 40,000, and now standard deduction of 40,000 in salary is being increased to 50,000. Very easy amendment, very easy amendment. Standard deduction 50,000. Let's talk about amendments in your income from house property chapter. Amendment in your chapter income from house property, both amendments with effect from AY 2021. Whenever a property is held as stock in trade, whenever a property is held as stock in trade, initially it will not suffer DLOP provisions, but if it is not sold, what is the existing time limit? If it is not sold up to 1 year from the end of the financial year in which the completion certificate CC is received, then it will become deemed to be let out property. What is the time limit? 1 year from the end of the financial year. So supposingly you have received your completion certificate in the financial year 1920, so end of the year will be 31st March 20 plus 1 year, 31st March 21. If you do not sell your property held as stock in trade by that date, then your property held as stock in trade will also suffer deemed to be let out property provisions. That's the existing law. What is the change? The change is only this much. The time limit is being changed from 1 year to 2 years. So amended from existing 1 year to 2 years. Currently the time limit available to sell your stock in trade is 1 year from the end of the year in which CC is received, but now we are changing it to 2 years from the end of the year in which CC is received. That's the first change. And second change again brought by the interim budget. Interim budget was basically to give a lollipop just before elections. One of the biggest changes that I have seen in my career as a student and then as a teacher, that amounts to a total career of about 13 years, 3 years as a student and then 10 years as a teacher. In 13 years, one of the biggest changes that I have seen in direct tax, now you are allowed to claim two properties as self-occupied property. Two properties will be covered in self-occupied property, and the total deduction of the two will be restricted to 2 lakh rupees. So you are not going to get extra deduction, but earlier after one house, all other houses used to fall under deemed to be let out provision, but now DLOP provision will be applicable from your third house onwards. That means basically what happens is, we are people living in Mumbai, and our native place, we are natives of a state of Rajasthan. So we have our one house in Mumbai and one house in Rajasthan. What was earlier happening was, you can take only one house as SOP. So automatically the other house, which generally used to be the house in Rajasthan being the lower value, it had to be taken as deemed to be let out. But for those people who are traveling, basically their origin is at one place and for work purposes they are staying at another place, keeping that logic in mind, it was announced that we will now allow you. Big change, easy to understand, but very high level practical implication. You are now allowed to claim the value of two properties as self-occupied property. So from the third property onwards, DLOP provisions will get attracted. Assessee will be eligible to claim two houses as SOP. Clear? Next, head of income, profits and gains of business or profession. Profits and gains of business or profession. Only one amendment has come in all the sections. Section 32 is depreciation, 35AD is specified business, 40A subsection 3 payment more than 10,000 modes of payment, 43CA stamp duty value rule if immovable property is held as stock in trade, and 44AD presumptive taxation. In all these sections there is restriction on mode of transaction. Account pay check, account pay draft, electronic modes through a bank account. This amendment we saw in 269 SS, 269T, we saw in political parties, and whichever chapter of income tax there is restriction on mode of transaction. That three modes are covered: account pay check, account pay draft, and electronic clearing system through a bank account. In all those chapters now we will also cover other prescribed electronic modes. So electronic modes can be through bank or other prescribed modes. I told you about RuPay debit card and UPI. So such transactions are also now going to be covered. Are we clear? Next chapter, capital gains. Capital gains. Certain amendments, small amendments have taken place, very easy to understand. First, any non-resident transferring notified bonds in any international financial services center excluded from the definition of taxable transfer. We are excluding it from the definition of transfer. That means on such a transaction, capital gain will not arise only. So we have already studied certain tax benefits of international financial services center, like non-resident earning interest, it is going to be exempt. No IDT, no DDT, no STT, still you will get 111A, 112A, rate of MAT will be 9% instead of 15. So already for other companies also there is an amendment. 18.5 is brought down to 15%, but for IFSC it is going to be 9%. And one more benefit, whenever non-resident is transferring any notified bonds on international financial services center, then such transaction will not attract any capital gains, because we are excluding this transaction from the definition of taxable transfer. Next, this amendment already discussed. If you want, you can cover 50C over here itself, that now other prescribed modes for any person wanting the benefit of agreement date stamp duty value, that came in 43CA, in 50C, and in income from other sources also. If you want agreement date stamp duty value, then you have to receive the advance in account pay check, account pay draft, or electronic clearing system through a bank account. And now we will also cover other prescribed electronic modes. So same amendment has come in a lot of chapters. Next, very important amendment will apply on any question where you are solving long-term capital gains. The cost inflation index for the financial year 1920 will be 289. So you have to learn only two indices for your exam. One, base year 0102 cost inflation index is 100, and your exam year 1920 it is 289. In between, if there is any year, then that cost inflation index will be given to you in the question. Are we clear? Next, section 50 CA. First, let me remind you what is 50 CA. Whenever there is a sale of unlisted shares, the selling price will be actual selling price or fair market value, whichever is higher. Just like for immovable property, we have stamp duty value rule. For unlisted shares, actual selling price or stamp duty value, out of the two, whichever is higher. But CBDT will notify certain exceptions on which the provision will not be applicable. So honestly, in the act they have made only this change that we will notify exceptions. We will have to wait and watch if there is any circular announced, for which we have a separate video, case law lecture. In the case law lecture, we cover circulars, RTP and everything. So if at all they notify any exception, we will talk about it in our case law lecture. Here the amendment is that we will notify exceptions to 50 CA. Next, again an amendment which came in the ordinance. Ordinance amendment. No, sorry, not ordinance. Pardon. Not ordinance. In the interim budget, just before elections, to give a lollipop to the assessees. Just before elections, to make assessees happy. A big change, again one of the biggest changes that I have seen in my career as a chartered accountant, under section 54. Till now the rule was, whenever you sell a house, you buy another house, for buying within 2 years or constructing within 3 years, the amount invested in the new house will be exempt from the capital gain on the old house, but you will get exemption of maximum one house. Under section 54, we were getting exemption of maximum one house, but now if the capital gain, it has to be long term capital gain, is up to 2 crore, then you can acquire 2 houses and claim exemption for both. That means till now under section 54, exemption was available only for one house. Now exemption will be available for 2 houses. Till now exemption was available only for one house. Now we will give you exemption for 2 houses. But what is the condition? Your capital gain should be up to rupees 2 crore. This benefit will be available only if your capital gain is up to rupees 2 crore. Secondly, whatever rules are applicable for the first house, for example, purchase within 2 years, construct within 3 years, it has to be in India. You cannot sell it within 3 years lock-in period. Whatever rules are applicable for the first house shall be applicable on both houses. So conditions will be same, but the change that has taken place is you can take exemption of 2 houses. 2 houses if your capital gain is up to rupees 2 crore. Equal to 2 crore is also covered. So if your capital gain is less than or equal to 2 crore, if your capital gain is less than or equal to 2 crore, then you can take exemption of 2 houses, but this exemption is going to be once in a lifetime. This exemption is going to be once in a lifetime. So you can take exemption of 2 houses if your capital gain is up to rupees 2 crore. However, you can take that exemption only once in a lifetime. Only once in a lifetime. Are we clear? Next. Section 54 GB is when you sell property and you are investing in any startup or you are investing in a manufacturing company, then the lock-in period for computer or computer software, we are making it 3 years, and right now the rule is that the assessee's voting power in the newly created company, the assessee's voting power in the newly created company should be 50%, but we are reducing that requirement to 25%. So the existing requirement of 50% is being reduced to 25%. These were your amendments in your chapter called capital gains. Let's go ahead. Next chapter, income from other sources. First of all, section 56 to 10 is the provision for gift. Just like 50CA brought this amendment that there will be notified exceptions, we now say that we will notify some exceptions to the gift section also. So there will be certain cases which will be notified by way of an exception to section 56. In other words, cases where gift will not be taxable. The existing exceptions are gift received at the time of marriage is exempt, gift received from relative is exempt, gift received due to death, will, inheritance is exempt, shares received at the time of amalgamation or demerger is going to be exempt. If you are receiving any money from charitable trust, educational or medical institution, that is exempt. But now we will have some more notified exceptions where gift provision will not be applicable, and for receiver of immovable property for inadequate consideration, where we get agreement date, stamp duty value, we have to pay some advance in account pay check, account pay draft, electronic mode, through a bank account or other prescribed electronic modes will also be now covered. We are here going to cover other prescribed electronic modes also. We will be covering other prescribed electronic modes also. Other prescribed electronic modes. So, this amendment has taken place in almost every chapter wherever there is restriction on the mode of transaction. So, very basic amendments in income from other sources. No amendment has taken place in your chapter clubbing of income. The next amendment has taken place in your chapter set off and carry forward of losses. Section 79, which is applicable to private company, that if you have any brought forward loss, then the total number of shareholders on the last date of the year of loss should be continuing as shareholder on the last day of the current year, for which we are notifying some exception. That same company which became an exception under MAT when we were calculating book profit, on the less side brought forward unabsorbed depreciation or business loss, whichever is lower is normally adjusted, but company applying for insolvency and the insolvency application has been accepted, we adjust both business loss as well as UAD. And what is the amendment in that calculation? Any company whose board of directors have been suspended or new board of directors have been appointed, then such company, subsidiary of such company or subsidiary of such company's subsidiary, in such cases the provision of section 79 shall not be applicable. That is, the restriction on shareholding is not going to be applicable. The existing restriction on shareholding, that minimum 51% shareholder should continue, is not going to be applicable in these cases. Next chapter, last chapter in your IPCC portion, deductions under chapter 6A. Some small basic amendments have taken place and a couple of new sections have also been introduced. First, let's talk about 80JJAA, because understanding this amendment is very easy. We have already studied this at a lot of places in our portion. In 80JJAA, also for getting deduction, what is 80JJAA? Remuneration paid, emoluments paid to new employees, 30% of your additional employee cost will be available as a deduction. There is a restriction on the mode of transaction, account pay check, account pay draft or electronic system. Is there a restriction? That will now also cover other prescribed electronic modes. Other than bank account, other prescribed electronic modes is also going to be covered. Is this understood? Next, contribution to notified pension scheme referred to in 80 CCD of employee of central government with a lock-in period of minimum 3 years will now be covered under 80C. Actually, government proposes to stop this system of pension. We now want to stop the system of pension because paying pension is becoming a very big financial burden to the government. So government wishes to encourage you to build your own pension. So whatever contribution you are making to NPS and you are willing to have a lock-in of 3 years, we are going to give you deduction under 80C. Just like we have deduction for RPF, PPF, we are going to give you deduction if you are contributing with a minimum lock-in of 3 years. That's the amendment in section 80C. Next amendment is section 80 CCD subsection 2. If you remember, what is subsection 2? Employer contribution to NPS. The existing limit was 10% of salary, but for employees of central government, we are changing the limit from 10% to 14%. Same logic. We want to stop a payment of pension. So when you are working, you make us contribute any amount, we will give you. But once you retire, we don't want to give you anything. Once you retire, we want to stop the system of pension. For this reason, during your work life, we will give you extra. So instead of 10%, employer contribution exemption will go up to 14% of salary. So 80 CCD2 is the deduction, not exemption, sorry. 80 CCD2 is the deduction for employer contribution to NPS. For private sector employees, even today the limit will continue at 10% of salary. For private sector, it will continue at 10% of salary, but for any employee of central government, the limit will change from 10% to 14%. For employees of central government, the limit is going to change from 10% to 14% of your salary. For employees of central government, limit will change from 10% to 14% of your salary. Understood? Next 2 points are actually the 2 newly introduced sections. Both are regarding interest. So they are sections 80EEA and 80EEB. Let's talk about them one by one. If you are taking loan for buying a house property, government wants to promote housing for all, and for this purpose we want to encourage you to take loans. If you want to take a loan, if you are an individual, you will get deduction, but you should not be eligible in 80EE. 80EE is also interest on home loan, but 80EE is any person who has taken a loan during the year 16-17. If you have taken a loan during 16-17, that means you are eligible for 80EE, then you will not be eligible here. In 80EE, there is already a limit of 50,000, you can take that limit. But now 16-17 is gone. So any assessee taking a loan today will not be eligible for that 80EE, and thus we are bringing a new section, actual interest or 1,50,000, whichever is lower, maximum 1,50,000. So listen. Whatever is your actual interest, first preference will be given to SOP. First preference will be given to SOP. There is a condition, assessee should not own any residential house property. That means, can I say this is going to be your first house? And if it is going to be your first house, can I say it is self-occupied property? And see, if it was LOP, no, so unlimited interest is already allowed in house property. You don't need any section in chapter 6A. The problem is with SOP, where your house property interest deduction is limited. Your house property interest deduction is limited to a maximum of 2 lakh rupees. So after taking 2 lakh rupees, that means first preference has to be given to the house property section 24, and after giving 2 lakh, if there is still some unutilized interest, then you will get up to 1,50,000. So if your actual interest is say 3 lakh, you have taken 2 lakh in house property, here you can take 1 lakh. If your actual interest is 4 lakh, you will first take 2 lakh over here, and then the remaining 2 lakh will be restricted to 1,50,000 over here. So actual interest or 1,50,000, whichever is lower, but that actual interest will be after taking SOP. First we will take SOP, then we will come here. Let's see the other conditions. Individual not eligible for 80EE, actual interest first take SOP, then remaining you bring here up to maximum of 150. This is your first house. Loan should be taken from any financial institution. Once you take this deduction, you will not get any deduction under any other section. Obviously, this loan should be taken during the year 1920. This loan should be taken during the year 1920. That means any loan taken during 16-17, 80EE will be available and the maximum limit will be 50,000. And any loan taken during 1920, 80EEA will be available and maximum limit will be 1,50,000. The value of the house should be maximum 45 lakh. In 80EE, the value of the house was allowed up to 50 lakhs and loan was allowed up to 35 lakhs. Here we are reducing the value of the house further. So we want poor people to be able to buy affordable houses. We don't want rich people buying houses worth crores of rupees and taking this deduction. We want poor people. We want poor people to be able to buy houses, and thus the value of the house should not be more than 45 lakh. In this section 80EEA, they have not put any restriction on the value of loan. In 80EE, house not more than 50 lakh and loan not more than 35 lakh. But please understand, if the value of house is reduced from 50 to 45, then obviously bank is not going to fund entire 45. Bank will give you maximum 70-80%. So automatically your loan sanction amount will be somewhere near that limit only. Even if they have not put any limit on the amount of loan, the limit on the value of the house property will automatically take care of that. So In 80EE, limit of house 50 lakh, but here it is only 45 lakh. In 80EE, limit of loan is 35 lakh, here there is no such limit. Over there, interest is 50,000, here it is maximum, both cases 50 and here it is maximum 1 lakh 50. Over there also, you have to give first preference to SOP here also. That loan was sanctioned during 16-17. This loan is sanctioned during 19-20. Are we clear? Next section, again newly introduced section. Again in respect of interest, deduction under section 80EEB, deduction in respect of interest for the purchase of loan taken for the purchase of electric vehicle. So all the government plans are being reflected in tax provision. The government is promoting clean energy. Government wants you to move away from fuels like petrol and diesel, which is the reason they are continuously increasing the prices of petrol and diesel. They do not want petrol and diesel to be very cheap, and because they want to promote electric vehicles. So already central government is giving subsidies, some state governments are giving subsidies for purchase of electric vehicle. Plus, if you don't have money to buy a vehicle and you take a loan to buy electric vehicle, you will be paying interest. You will be paying interest up to a maximum of 1,50,000 if you are an individual. So any company, firm or HUF buying electric vehicle will not be eligible. If you are an individual, actual interest or maximum 1,50,000, whichever is lower, will be allowed under 80EEB. So 80EEA is interest on home loan and 80EEB is interest on loan taken for purchase of electric vehicle. The limit of deduction for both sections is same, up to a maximum of 1,50,000. So loan should be taken, again financial institution, for purchase of electric vehicle, maximum 1,50,000. And as a clarification, the deduction shall not exceed 1,50,000 and shall be applicable from assessment year 2021. And where a deduction is taken in this section, obviously you will not get deduction under any other section. If that car is purchased for the purpose of business and the interest ka deduction you are taking under PGBP as expense, if you are taking the interest deduction as expense under PGBP, then obviously you are not going to get this deduction. So this is for those who are buying personal car and not claiming interest deduction. You can claim 80EEB up to a maximum of 1,50,000. So loan taken for the purchase of electric vehicle, and this loan can be taken from 1/4/19 till 31st March 23. So there is a difference here. For home loan, it has to be taken, the home loan has to be taken during the year 1920, but this loan can be taken in 1920, 2021, 21-22, 22-23. We are giving you 4 years time. So listen, most of you all are CA articles right now. Very soon you will become CA and you will be able to afford a car. And by that time the country will have better infrastructure also. As of now, even those who want to buy electric vehicles hesitate because there are not enough charging stations, fuel stations. By that time the country's infrastructure will definitely have plenty of fuel stations, just like petrol pump and diesel pump. They will be having quite a few electric charging stations, and then you will have money also. Then you can take the loan till 31st March 23. You will be eligible. So home loan has to be taken during 1920, but electric vehicle loan can be taken till 31st March 23. Understood? Next amendment has come in section 80IBA. 80IBA, and this is for projects that are approved on or after 1st September 19. For 80IBA, we had some conditions. Deduction for new housing project to developers, location of the project, plot size, carpet area. We had some existing conditions. And the location was divided in two categories. Here in the first category, they had covered only Delhi, Kolkata, Mumbai and Chennai. The existing places were only Delhi, Kolkata, Mumbai and Chennai, and all other places used to fall in category 2 with respect to these conditions. I will explain the conditions and the amendment also. But only 4 cities used to fall in category 1. All other cities used to fall in category 2. But now we are changing this amendment, and in category 1 metro cities we will cover Bangalore. With Delhi we will cover the entire national capital region. National capital region includes some small cities outside Delhi. City like Noida, Greater Noida, Gurugram, it is also known as Gurgaon, Ghaziabad, Faridabad. This entire area is called Delhi NCR, National Capital Region. These places will also fall in metro cities. So Bangalore is added, National Capital Region is added, Hyderabad is added, and in Mumbai also we will add the whole Mumbai metropolitan region. Mumbai also has some places outside Mumbai, immediately outside Mumbai, a place like Navi Mumbai, a place like Thane, a place like Mira Bhayandar. There are these places which actually fall outside Mumbai. But there are people who do daily up down to these places for work purposes. Mumbai local train goes up to these places. And thus we are going to cover entire, just like we are covering National Capital Region, we will also be covering Mumbai Metropolitan Region. That means now in metro cities, we were covering Mumbai, Delhi, Chennai, Kolkata. We will add Bangalore, the entire city, Hyderabad, the entire city, and along with Delhi NCR and along with Mumbai, Mumbai Metropolitan Region will also be covered. And now other places will cover anything other than this. So basically the definition of metro cities has some additions which are removed from here and put over here. As far as size of the plot is concerned, no amendment. So here minimum plot size 1000 square meter, here minimum plot size 2000 square meter. But there is change in carpet area. The existing maximum carpet area was 30 is changed to 60, and here it was 60 is changed to 90. In metro cities, the size of the house was not allowed more than 30 square meter, and non-metro not allowed more than 60 square meter. 30 and 60 are being respectively changed to 60 and 90. That means carpet area of the house in metro cities, and metro cities definition also is changing. Carpet area of the house in metro city can be up to 60 square meter now, and in non-metro city can be up to 90 square meter now. This has not changed. This is still 90% and 80% construction area. But any project approved on or after 1st September 19. So please understand, if the project is already approved, these amendments are not applicable. Now if a new project is being applicable, definition of metro city has changed, and size of the house we are increasing the maximum limit. 30 and 60 is increasing to 60 and 90, and on or after 1st September 19, the stamp duty value of the house should be maximum 45 lakh. The whole idea behind this section 80 IBA was that developers should construct small size houses. Developers should construct small size houses at lower value so that people belonging to low income category can buy the houses. That was the whole idea behind creating your section 80 IBA, and this idea is now being reflected that the stamp duty value of the house for project approved again on or after 1st September 19, for project approved on or after 1st September 19, the stamp duty value should not be more than 45 lakh rupees, should not be more than 45 lakh rupees. So these are the amendments that have taken place in your chapter deductions under chapter 6A. These are the amendments, and as far as extra chapters in new syllabus are concerned, model tax convention, tax treaties and BEPS, there is no amendment in all the chapter. This is your amendment lecture in full English language. Separate video will be available for students who want a combination of both languages for better understanding purposes. This is the end of your amendment lecture. I hope you like the lecture. Thank you very much. All the best. Do well. Take care. See you. Bye.